In this video, I'm going to show you how to account for a sale and leaseback transaction in the books of the seller-lessee in a situation where the sale is above fair value. Let's go through this question. Become Limited entered into a sale and leaseback on 1st January 2018. It sold an asset with a carrying amount of 300,000 Ghana cedis. So we have carrying amount of 300,000. Sold it for 400,000 Ghana cedis and leased it back over a 5-year period, equivalent to its remaining useful life. Prior to the sale, the asset had a fair value of 350,000. So this is the fair value. The transaction constitutes a sale in accordance with Ifrs 15, revenue from contracts with customers. The lease provided for 5 annual payments in arrears of 100,000 Ghana cedis. The rate of interest implicit in the lease is 10%. You are required to pass a journal to record the transaction on 1st January 2018 and also prepare extracts from the statement of profit or loss and statement of financial position at 31st December 2018. Alright, so this is a sale and leaseback. Where the sale is above fair value or above the market price. And the criterion or the caveat is that sale is in accordance with Ifrs 15 criteria. So this is the situation where the sale is a sale. That is, it meets the recognition of a sale under Ifrs 15, which says that a sale is recognized when a performance obligation is satisfied. Okay, a sale is recognized when or as a performance obligation is satisfied. In a situation where the sale is made at fair value, okay, the sale and leaseback transaction is above fair value or above the market price, you go through 6 steps in order to generalize the transaction on the date of commencement of the lease, okay, or on the date on which the transaction took place. The first thing is to recognize the sale proceeds. So recognize the sale proceeds. After recognizing the sale proceeds, the next thing to do is to de-recognize the asset. So de-recognize the assets. So when you sell an asset, you either receive cash or let's say bank, or it becomes a receivable. Then the other entry is to de-recognize the asset from your books. So you take the carrying amount of the asset off from your books because you no longer control it. So this is in relation to the sale aspect. So the double entries you make when you sell an asset. The third thing is to recognize additional financing. Or extra liability. Alright, we'll talk about that later. The fourth thing is to recognize a lease liability. Then you recognize a right of use asset. This relates to the lease aspect because Ifrs 16 says that at the commencement date, the lessee has to recognize a lease liability and a right of use asset. Then lastly, the seller-lessee should recognize a gain or loss. A gain or loss on transfer. So this is the balancing figure. After doing the 5 or after generalizing the 5 above, the balancing figure will be a gain or loss depending on the balance it has, whether it has a debit balance or a credit balance. In A, we are required to pass a journal to record the transaction. So we have become limited. So I'm preparing a journal for become limited. We have debit and credit. Bring our currency signs here. The first step says we should recognize the sale proceeds. So we are told that the asset was sold for 400,000. Okay, 400,000. So we have cash or bank. We are going to recognize the sale proceeds of 400,000 because it's a receipt. We recognize it at the debit side. The second step is to derecognize the assets. Once it has been sold, we no longer own it, and so become limited should derecognize the asset. It should take off the carrying amount from its books, and the carrying amount of the assets is 300,000. Since assets have a debit balance, derecognizing them will mean that you have to credit them. So we credit PPE with 300,000. The third step is to recognize additional financing or extra liability. So we have additional financing, or extra liability. Let's go back to the question. You realize that the asset was sold for 400,000, okay, but the fair value of the asset was 350,000. So in the market, the asset is worth 350,000, but Become Limited received an amount of 400,000. So the sales proceeds is in excess, or it exceeds the fair value of the asset by 50,000. This is an additional financing in the form of a loan, okay, that the buyer lessor is giving to Become Limited. So the difference between the sale proceeds of, so we have sale proceeds minus the fair value. Become Limited received 400,000 in sale proceeds, but the fair value of the asset was 350,000. So when you go to the market, the value of the asset is 350,000, but then Become Limited received in excess of that. He received 50,000 in excess, and this figure is what should be recognized as additional financing, because the buyer lessor is giving Become Limited more than is due him on the basis of the fair value of the assets. So we have 50,000 as extra liability or additional financing. The fourth step is to recognize a lease liability. So we have lease liability. So we do a working on that. We have our working one. The lease liability is the present value of all future lease payments. So we find that by multiplying the annual lease payments multiply the annual lease payments by the annuity factor. Alright. In this question, we are told the annual lease payments are 100,000 Ghana cedis, and the interest rate implicit in the lease is 10%. So we multiply the annual lease payment of 100,000 by the annuity factor, and the annuity factor is calculated as 1 minus 1 plus r raised to the power negative n all over r. R represents the interest rate implicit in the lease, and n represents the number of lease payments remaining, or the number of future lease payments. So in this question, we have 1 minus 1 plus r. R is 10%, so that is 0.1. Because the lease term is 5 years, and then payments are made in arrears, that is at the end of the year, it means that at the beginning of the year, Become Limited has 5 future lease payments to make. So raised to the power minus 5. Then we divide it by the interest rate implicit in the lease of 10%. So we have 100,000 multiplied by the annuity factor of 3.7908. That is, if we round it to the nearest fourth decimal place, or to 4 decimal places. This gives us a lease liability, a total lease liability of 379,080. This is the total. Alright, so this calculation we did here, the amount we've arrived at, that is 379,080, represents the total lease liability. Okay, this represents the total lease liability. This means that the sale process of 400,000 that Become Limited received, it is going to pay this particular amount. It has a liability of 379,080 to redeem the loan that he has received. Okay, this is the total. So in order to determine the actual lease liability, we have to subtract the additional financing or the extra liability. So we determine the proper lease liability or the actual lease liability by subtracting the additional financing from the total we've calculated here. So we have 379,080. We are going to subtract the additional financing or the extra liability, okay, from it, because the 379,080 is made up of this amount. So we have to take it off in order to determine the actual lease liability, and this gives us 329,080 as the actual lease liability. This is what we are going to recognize in our journal. It's a liability, so it has a credit balance. So 329,080 here. Alright. The next step is to recognize a right of use assets. So we have right of use assets. That is Workings 2. So right of use assets is determined by dividing the lease liability, that is the actual lease liability, by the fair value of the asset. Then we multiply it by the carrying amount of the assets. The actual lease liability we had was 329,080. So we have 329,080. Then in the question, we are told the fair value of the asset is 350,000, while the carrying amount is 300,000. So we divide it by 350,000, which is the fair value. Then you multiply it by the carrying amount of 300,000. And this gives us a right of use asset of 282,069. So this is our right of use assets. Alright, subsequently, the lease liability is going to be amortized and the right of use asset is going to be depreciated if it is a depreciable asset. So we have subsequent measurement. And this is the lease liability, so we are going to amortize it. So we are preparing our amortization schedule for the lease liability. In preparing our amortization schedule, we begin with the year. So we have year. We have open lease liability. Then we have our finance cost. We are going to calculate that based on the interest rate implicit in the lease of 10%. Then we have our lease payments. We also have capital repayments. And finally, the closing lease liability. So we have our Ghana cedi, our currency sign here. The transaction took place in 2018, so we are starting with 2018. The opening lease liability is the actual lease liability we calculated here. So we begin with 329,080. Then we find 10% of this amount, that gives us 32,908. The annual lease payment, we are told in the question, is 100,000. It's an outflow, so we put it in brackets. Then we determine the capital repayment by netting the finance cost and the lease payments. This gives us a figure of 67,092. Then we determine the closing lease liability by subtracting the capital repayment from the opening lease liability, and that gives us 261,988. We go to 2019. The opening balance will be the closing balance for the previous year, so we have 261,988. We find 10% of that, we have 26,199. That is if you round it off to the nearest whole number. The lease payment is still 100,000. When you net off the finance cost and lease payment, we have a capital repayment of 73,801. Then when you subtract the capital repayment from the opening lease liability, we have a closing lease liability of 188,187. We are told to show extracts for 2018 alone, so we can leave the amortization schedule here. With respect to the right of use asset, we are subsequently going to depreciate it. Okay, so depreciation of right of use assets. So we are going to depreciate the cost. The cost of the right of use assets is 282,069. So we have 282,069. Then we are told the lease term is for 5 years. So we divide it by 5 years. And this gives us an annual depreciation charge of 56,414. That is if you round it off to the nearest whole number. This is the annual depreciation charge. Alright, so having done this, we can show extracts in the financial statements. So the name of the company is Ecom Limited. So we have extracts from the statement of profit or loss. For 2018. Alright. So one of the expenses is finance cost. When we refer back to the amortization schedule, we had in respect of 2018, we have finance cost of 32,908. It's an expense, so we show it as a debit. So that is 32,908. Then we have depreciation expense. We show that one too as a debit. The annual depreciation charge is 56,414. So we have 56,414. And then when we were preparing the journal, we realized that the balancing figure, okay, so let's fill it in here. The right of use asset, we had 282,069. So right of use asset 282,069. Now you sum up the credit side figures. So we have this plus that. Okay. You sum up all of them. Then you sum up the debit side. When you do that, you realize that the credit side falls short. Sorry, the right of use asset is an asset, so it will be shown as a debit. So we have 282,069. So you sum up the debit side and the credit side, and you realize that the credit side falls short. Okay, so the balance will come to the credit side. That will represent a gain. Gains have credit balances, so gain on transfer. That is the balancing figure. We have 2,989. So when you do that, you realize that the debit side agrees with the credit side. So it is the 2,989 that you are going to recognize in the statement of profit or loss as a gain. So we have gain on transfer of rights. Gains have credit balances, so we have 2,989. Now we can go on and prepare extracts from the statement of financial position. So we have Become Limited, extracts from the statement of financial position. As at 31st December 2018. Right. So we have our assets. Under assets, we have the right of use assets. In our workings, we realize that the right of use asset has a cost of 282,069. And then the depreciation charge in respect of the right of use asset is 56,414. So we net off the two amounts to determine the carrying amount. So we have an amount of 282,069. 282,069. Then we less the depreciation charge of 56,414 from it. And that gives us a carrying amount of 225,655. Alright, then we come to the liability aspects. So we have our liabilities. We have the current component of the lease liability. So current lease liability. And the non-current component. So non-current lease liability. Let's refer back to our amortization schedule for these figures. So between 2018 and 2019, the closing lease liability reduced by 73,801. Okay, when you subtract 188,187 from 261,988, that is the closing balances of 2018 and 2019. When you subtract them, you get a difference of 73,801. That is the current lease liability. So the current lease liability for 2018 is 73,801, and the non-current one is 188,187. When you sum up the two, you are going to get 261,988. So we have 73,801 as the current, and then 188,187 as the non-current lease liability. Alright folks, this is the end of this tutorial video on sale and leaseback in a situation where the sale is above fair value. Once again, I entreat you to subscribe to the channel if you haven't done so, and then like, comment, and then share the videos for me. Thank you very much for your time, and have a great day.